Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Today, I'll be focusing on a worked example of a control account question. You may be wondering what is a control account. If you missed that lesson, the link is in the description below. And before I go into the lesson, what are the objectives? These are, at the end of the lesson, you should be able to prepare a sales ledger control account from a set of balances. And the other is to prepare a purchases ledger control from a set of balances. Now, what is the concept? What is the concept as it relates to preparing these? In preparing the control accounts, we use the same concept of a T account or a ledger account. You should know by now that T accounts are ledger accounts. Now, once we're referring to that, you know that increases and decreases will come up. So definitely you would have to use those in determining whether you're going to debit or credit the either the sales ledger control or the purchases ledger control account. But the first thing that we're going to look at is the sales account. What is the principle? Remember, the alternative term for sales ledger control is total debtors control, right? So it therefore means that in preparing this, we're going to use the double entry rule as it relates to debtor. Remember, debtor is classified as an asset. So therefore, where there is an increase, you're going to debit the sales ledger control. So there's a debit entry. And where there is a reduction, you're going to make a credit entry. For the purchases ledger control, the alternative term is total creditors control. So in doing this, you would need the concept increase and decrease as it relates to your creditor, which is classified as a liability. Where there is an increase, you're going to make a credit entry, while for the reduction, you're going to make a debit entry. Okay? Now, at this time, I'm going to take you to the question. So we're now going to look at a work example. This question is taken from CSEC January 2011, and it is question 4. Remember, a tip before you answer your question is that you have to read the question and analyze it. Find out what you're required to do. So you're presented with Mr. Best, prepare the following information in order to produce end of year figures for his final accounts. You're given a list of totals and balances coming from the ledgers. And you're asked to prepare the sales ledger control account and the purchases ledger control account. So while going through, I'll be explaining the reason you debit, the reason you credit, etc. No, you can do both accounts together. So what I'm going to do is label the T's, Mr. Best, sales ledger control account. And this one at the bottom here will represent Mr. Best. Purchases ledger control account. Now, in exam, you can decide whether you want to do one and then you do the other, or you could just make your entries in the respective accounts as you go along. I'll be making the entries in the respective accounts as we look at the items. So the first one we're seeing sales ledger balance is January 1st, 2010. So the period, if you notice, it ends December 31st, 2010 and begins January 1st, 2010. These figures that are presented to you at January 1st, these are your opening balances. So sales ledger balances, January 1st, 2010, debit balance. And you're seeing sales ledger balances, January 1st, 2010, credit balance. Now, you should know that the debtors carry a debit balance because, of course, this is an asset. But there may be cases where the sales ledger control carries a credit balance. And what are these cases? You may be asked these in exam just the same. So you need to note that the sales ledger control may carry a credit balance where a customer returns goods after paying for them in full, or where the customer makes advance payments, where the customer is overcharged, or where the customer overpays his account in error. So those are some reasons why the sales ledger control may carry a credit balance. Now, let's put in those balances. So the year is 2011, and that's January 1st, or details is balance brought down because that's our opening balance. Because it said debit, we're going to enter this 25,260 on the debit side. So you'll put $25,260 right there. And outside of that, if you just get a question where you're presented with sales ledger balance, it did not indicate whether it is a debit or credit. Please note that the sales ledger control carries the normal balance is a debit balance. If it is in brackets, then it means that it is a credit balance. But once it is positive, then that is a debit balance. They may put CR beside it to represent credit just the same, or DR beside it to represent debit. Once you're doing opening balance, whatever the question indicates, that's the entry that you're going to make. So for the other, which is our credit balance, our date is in fact 2010, the year. So this would be January 1, or details is balance brought down, and the amount, because they have indicated that it is a credit balance, you put this 540 on the credit side. So we're finished with the sales ledger balances. Now we're on to the purchases ledger opening balances. And we're seeing where there's a debit balance of $350 and a credit balance of $32,130. So let's make those entries. Please note that the purchases ledger control, the normal balance is a credit balance, right? But it may carries a debit balance, and these are the reasons. If it is that the firm returned goods after paying for them in full, where the firm makes advance payments on its account, where the firm has been overcharged by the supplier, or where the firm overpays its account in error. So those are some reasons. Now, we're going to make the debit balance entry. So that's January 1, balance brought down, and the amount is $350. That's coming from the question, $350. And there is a credit balance, so that's 2010, January 1, balance BD, which is our details, and the amount is $32,130. So we're finished with the opening balances. Now, total receipts from customers. In looking at these guys, you need to ensure that you pick up the items relating to your customers, these would go to your sales ledger control because those are your debtors. And remember, your sales ledger control alternative term is total debtors account. So what relates to your debtors go to your sales ledger control. What relates to your creditors, which are your suppliers, those would go to your purchases ledger control. Total receipts from customer. This is saying that our debtors paid us. And once your debtors pay, because this is an asset, that's a reduction in the account. And because there's a reduction, you are going to make a credit entry. This is at the end of the year. So we're going to use the ending of the period, which is December 31st as our date. And the details, you can write cash book, or you can simply write receipts from customers. So I'll be using cash book. That still represents the receipts from your customers, or you could write bank, just the same. And the amount there is $392,690. Now, the other item from the question is total payments to suppliers. Because it states suppliers, then we know definitely that this should go to our purchases ledger control because that relates to our creditors, right? The amount that was paid to the suppliers is $308,160. Now, when you pay your suppliers, would that result in an increase or decrease in your amount owing to these individuals? Definitely that will be a reduction in the amount that you're owing. And the fact that there's a reduction, you're going to make a debit entry to your purchases ledger control account. Again, that's the end of the period, so we're using December 31st. Your details can simply be cash book because that represents the payment. That's where you would get the total payments to your suppliers from. And the amount is $308,160. Now, bear in mind that if it is that you write payments to suppliers as your details, nothing is wrong with that. So you could write that. Now, let's move on to the other item, purchases on credit. Purchases on credit, right? So we have made purchases on credit. So this would come from the purchases journal. That's where you get that details from. And basically, once we have made purchases on credit, it therefore means that we're now owing to our suppliers more. So that will be an increase in the purchases ledger control. So that's a credit entry, and that is December 31st because that's the end of the period where we're picking up the totals. And our details, you can simply write credit purchases. So you can simply write credit purchases, or you could write purchases journal as your details. And the amount coming from that is $321,100. Moving on to the next item, sales on credit. Once we sold goods on credit, then of course we're going to end up with debtors. And that relates to our sales ledger control. So therefore, we're going to make that entry in our sales ledger control account. Now, is that a debit entry or a credit entry? It is a debit entry because once you sold goods on credit, your debtors are owing you more. So there's an increase in the value of what is owing to our business. That's an increase in your debtors. So therefore, you're going to make a debit entry. Our details can simply be credit, sales, or you could go ahead and put sales journal as your details. And the amount is $412,500. Please ensure that once you're entering your figures, double check to ensure that the figures that you enter are accurate. The other item is discount allowed. Who do we give discount to? These would have to be our customers. So therefore, again, this is our sales ledger control account entry. But is that an increase or decrease in what they would be owing to us? Because we offer that discount to them, it will decrease the value that they are owing to us. So therefore, we're going to make a credit entry. And our details there is discount allowed, and the amount there is $3,220. $3,220. Next item, discount received. Discount received. And the value is $4,660. $4,660. Now, would that be our sales ledger control or purchases? The fact that we receive the discount, it knows that is coming from our suppliers. So therefore, that will decrease the amount that we're owing to them. And the fact that it decreases the amount that we're owing to them, that is a debit entry. Remember, you decrease on the debit side for your purchases ledger control and you increase on the credit side. Our details is discount received, and the value is $4,660. Next item, returns inwards. Returns inwards. And this would be our customers returning goods back to us. Because they're returning goods back to us, it means that it is decreasing the value of what they're owing. So therefore, that is a credit entry. That is returns inwards. And the value for the return inwards is $2,100. Now, next item, returns outwards. We are returning goods back to our suppliers. Does that increases or decreases the value that we're owing to our suppliers? Because we're returning some of the goods that we have taken from them, it will decrease the value of what we're owing to our suppliers. So therefore, that results in a debit entry. And apart from that, once there is return outwards, we know that our returns outwards account is credited. So therefore, the other item should be debited. So it's simply double entry that you're doing. The value is $1,500. Next item, bad debts written off. What is bad debt linked to? Remember, we did a lesson on that. Bad debt is linked to our customers. And once you're writing off bad debt, you're reducing the value of what the customer is owing to the business. You're writing off the balance that is owing by that particular customer because of bankruptcy, etc. So therefore, that's a reduction in our sales ledger control. We are going to make a credit entry, and our details is bad debts. Now, the amount for that is $2,800. Remember to double check with the value that you're recording. The next item is balance in sales ledger set off against balances in the purchases ledger. Now, what do we mean by set off? Basically, set off is a contra entry in the control accounts. So you'll find that the entry would be in your sales ledger and your purchases ledger control. But what is the idea behind set off? The fact is, there may be a person, the person that you buy goods from on credit, that would be your creditor. So there may be something that they supply that you want for your business and you purchase it from them. That same creditor could purchase goods from you on credit just the same. So you would be owing this person and that person would be owing your business. So your debtor becomes your creditor, right? Now, the value that the person is owing you, you may come to a decision and you say, you know what? Let us set off the balances. When you set off balances, what are you doing? You're basically using the balance from one to cancel out the other. So it's like you're squitzing then. So you have borrowed $200 from your friend, and your friend had borrowed $100 from you. You can say, you know what, let's squitz out. So what you'll be squeezing out is the lower value, which is the 100. And the only person that would be owing would be the individual that was owing the 200. They wouldn't owe 200 because you have canceled out, you have squeezed out that 100. So therefore that individual is only owing $100. Likewise, in this case, for the question, when you're doing set off, it's a reduction in the account. Set off reduces the value that is owing. So in your sales ledger control, and again, remember, there should be two entries. It's a contra entry, one to your sales ledger control, one to your purchases ledger control. And you're showing a reduction because set off is basically you're clearing off whatever is owing, but you're squeezing out. So the amount that we are setting off in the two ledger sales in the two control accounts is $500. So your details is set off, and you're going to indicate that you set off to your purchases, ledger. So in your sales ledger, you write set off purchases ledger because you're indicating that the other entry is in your purchases ledger control. The amount that we're setting off is $500. In a case where, for example, the question indicates 500 for sales ledger set off and 1,000 for purchases, which value would you set off? The response is that you would set off a lower value of $500. So again, another scenario, you may have $2,000 for sales and $1,500 for purchases. The value that you should set off is the $1,500 because you're squeezing out the lower value. So only the person that was owing the $2,000 would now be owing the difference between the $2,000 and that $1,500. So that's the entry for our sales ledger control. And of course, remember, once they're set off, there should be two entries, one in your sales ledger control, one in your purchases ledger control. It's a reduction. So in our purchases, we're debiting. So that's set off. And we're indicating that we set off our sales ledger. So if you go to your sales ledger, you should see the other entry, and the value that we're setting off is 500. Now, we have gone through the entries from the opening balances down to set off. So where we are at now is the sales ledger balance, December 31st. 2010, and these are your closing balances. And we have purchases ledger balance December 31st, 2010, and we're presented with a debit balance. Now, when you are given the closing balances, they're simply indicating that when you're finished, the balance brought down, for example, for the credit should be on the credit side. So the fact that this should be on the credit side, it means that we are going to make a debit entry. So we're going to debit our balance carried down, because when we're finished, the balance brought down should end up on the credit side, that is. So we're going to enter this detail, and remember, we are debiting because this is our closing balance, and they say closing credit balance, meaning the balance brought down should be on the credit side. To get the balance brought down on the credit side, or balance carried down has to be debited. So the value is our details balance carried down, and the value right there is $360. We have to determine our debit balance, right? So we have to ascertain what is our debit balance. And because we have to ascertain what is our debit balance, it means that the side that would be short is our credit side, because that balance CD would be reflected on the credit side in order for our balance to be, or balance brought down to be reflected on the debit side. So we're going to proceed in doing our calculation. And remember, this 360, which is our credit balance, you are to debit that as your balance carried down, which we did, or your balance carried down, because when you're finished, this 360 balance BD should be recorded on the credit side. So the balance BD should be on the credit side when you're finished. So let's go with our calculation. Remember, when you're balancing off, add up both sides, find the difference between that side, the side with the smaller value, that is where you enter your balance carried down. And we are now going to put in that value, balance carried down. And the difference between the two sides is $36,270. And the next thing that you would do is to enter your totals. The totals are $438,120. And over on your credit, you write that same total. And remember, your totals must be on the same level. So that's 438,120 as our totals. Don't forget to put your single line above and your double line below for your totals. Remember, that is the key concept. Now, when you're finished entering your total, the final thing to close off the balancing off process is to enter your balance brought down. Once you have CD, there must be a BD as follow-up to that, because you're showing what is the ending balance in this account. Coming out of December 31st, 2010, we move into 2011, and that is January 1st. Our balance brought down, which is our debit balance. Remember, we were required to find this, and that is our details balance brought down. The amount is 36,000, same thing as your carried down, $270. Now we're entering the balance, the credit balance. So that is 2011, January 1, details, balance brought down, and the amount is the same thing as your carry down, which is 360. So this is it, your 360 CD becomes your BD, and your balance carried on coming from the credit becomes your BD on the debit of $36,270. So we are finished with the sales ledger control. And if you notice, our debit balance is on the debit side. We enter the CD on the credit because that's a closing balance. The fact that they say it's debit balance, you have to enter that your CD is on the credit so that your brought down is reflected on the debit. Likewise, for the 360, which was the credit balance, if you notice, it is reflected on the credit side. We enter the balance carried down on the debit so that our brought down is reflected on the credit side. So we're now going to look at our purchases ledger control. We're going to fine tune that. And we only have one figure coming from the question to record in this. And it is our debit balance of 230. Because they indicated that it is a debit balance, what are we going to do with this 230? We are going to ensure that we enter the balance brought down on the credit side. So we're going to credit our balance carried down, that is, on the credit side, so that the BD is reflected on the debit. So here we go in making our recording. So that's balance carried down. The value given to us is 230. And we were required to find our credit balance. So this balance CD would be recorded on the debit side. And the fact that we were presented with the debit balance and you're seeing the question sign beside credit, it means that the side that is short is the debit side, right? So let's go through and do our calculation in determining the balance that we need to get this account complete. So you total your credit, total your debit, find the difference between the two. And the difference that we have is $38,290, $38,290. Our totals will be the next step. And our totals for both sides is $353,460. $353,460. And remember, your totals must be on the same level. Ensure you have your single line above, double line below for both totals. Now, in closing off, we must enter our balance brought down. Remember, once you have CD, there is BD. So that's 2011, January 1. Our details is balance brought down. And the amount, same thing as your carried down, which is $38,290. 2011, January 1, details, balance brought down. And remember, your CD and BD are opposite of each other. So if your CD is on the credit, your BD for that must be on the debit. If your CD is on the debit, like you're seeing right here, your BD must be on the credit. The amount that we're entering for balance brought down on the debit side is $230. Now, if you notice, from the question, it said purchases ledger balance December 31st, meaning their closing balance is, there's a debit balance of 230. You must get the balance brought down on the debit side. So it therefore means that we credit in order to get the debit of 230. Also, notice the 38,290 balance carried down becomes your brought down on the credit side. And for the 230 carried down from the credit becomes your balance brought down on the debit. Balance CD, balance BD carries the same value. Don't forget that. Now you may be wondering if it is that the question will always have the both balances. The question may carry one balance. It may carry two balances. But what you'd need to do is to ensure that you double check what you're doing. Another thing is that we were presented with the debit balance of 230. Once you record this this balance carried down on the credit side and you attempt to balance off, ensure that this side is larger than the other side, because you cannot have two balance carried down on the same side. One will be on the debit and one on the credit. Okay, so what we're going to do now is to just wrap up. And in wrapping up, I will be reviewing some key things that were discussed in the lesson from the worked example there. And remember, this is a sales ledger control format. This is a specimen. You can pause and take a look at it in details. So these are the items that would cause an increase in your debtor. So therefore you debit. These are the items that would cause a reduction in your debtor. So therefore you credit to your sales ledger control account. Notice your opening balance, remember, once it said debit balance, you are to debit that. If it states credit balance, you must credit. Also, the balance may just say sales ledger balance, and that figure is not in bracket. Once it is not in bracket, you are to debit that, because your normal balance for sales ledger is a debit balance. Okay? However, if it is in bracket, you must credit. You may get the balances together. The earlier date would be your opening balances. The later one would be your closing balances. Remember, for your closing balance, if they state debit balance, it means that the balance brought down must fall on the debit side. So it therefore means that you have to put your CD on the credit, and then your BD would be reflected on the debit side. Likewise, if the question states credit balance, you are to put your balance carried down on the debit side so that your balance brought down is reflected on the credit. Here is a specimen for your purchases ledger control account. Do remember, if it is that you are asked to, so that's the purchases ledger control format. That's a specimen. And again, we increase on the credit for the purchases. So purchases increase on the credit and decreases on the debit, right? Remember, we're using that same rule as preparing a creditor account. Creditor is a liability. Liability increases on the credit and decreases on the debit. Remember the concept for your balances: opening balance as opposed to your closing balance. Your creditor, which is your purchases ledger control account, normal balance is a credit. If it is positive, put that on the credit side. If it is in a bracket, put that on the debit. If you see DR beside it, debit it. If you see CR beside it, you credit. That's when you're starting out your opening balance. Remember, at the end, when it states that you have a debit balance, put your CD on the credit so that your BD would be reflected on the opposite side, which is the debit side. Vice versa for the credit balance. Another thing that we have looked at is the reason the sales ledger control carries a credit balance. And the sales ledger control carries a credit balance where a customer returns goods after paying for them in full, where the customer makes advance payment or payments on his account, where the customer is overcharged, and where the customer overpays his or her account in error. Now, for the purchases, we're looking at where the firm. So for the purchases, it would carry a debit balance if it is that the firm returns goods after paying for them in full, if the firm makes advance payments on its account, where the firm has been overcharged. And the final one is where the firm overpays its account in error. So those are the reasons your purchases ledger control may carry a debit balance. And of course, from time to time, they tend to ask these questions in exams. So do remember these. And items not approved for the control account, meaning items that you should not record in your control account. There wasn't any of these in the question that we have worked, but from time to time, your examiner may put these in the question as distractors. Remember, if it doesn't link to your purchases, your credit purchases, which are your creditors, if it doesn't link to your debtors, it should not be recorded in there. We're only dealing with credit items. So let's go with the list. Trade discount. Remember, trade discounts are not entered in any account. It should not be recorded in the accounting record. So therefore, it would not be in our control account. Another is cash sales and or cash purchases. You pay for the goods when you purchase them. The debtor the customer, pays for the goods up front when they were purchased. It means that there wouldn't be any creditor nor any debtor. So therefore, distractor, if you see it in the question, just put a line through that and proceed. We don't need that. Another is returns from cash sales and or cash purchases. Another one, provision for bad debt or doubtful debts should not be there either. Another, provision for discount on debtors. So do remember, those items should not be in your control account. They're simply distractors if you see them in the question. And the final one is provision for discount on creditors. So remember these items, they are not approved for the control account. See, they should not be recorded in your control account. And the final thing is set off. Do remember, the set off is where you have the same firm. This firm may be a supplier and a customer, and therefore inter-indebtedness takes place. One balance is used to cancel all or part of another that is owing. Remember, it is a reduction in the account. So therefore, for the sales ledger, you're going to credit, and for the purchases, you're going to debit. It's a contra entry. Remember, it is a contra entry, basically a contra settlement between the sales ledger and the purchases ledger control account. So this entry must be reflected in your sales ledger as well as your purchases ledger control account. Okay, when you're given two figures, you set off the smaller value. You set off the smaller value. So that is a tip right there. And that takes us to the end. When we started out, we aim at going through the steps and concept in preparing a sales ledger control and as well as a purchases ledger control. And I'm sure you're clear in how to prepare a control account, whether it be sales ledger control or purchases ledger control.
Like, share, and don't forget to subscribe.